Mark, first it was the software concern. Now it's liquidity around these retail funds. Just how existential of a moment is this for private credit? Is there going to be some real pain and scarring coming from, again, all of these risks that we're now starting to flag?
Yeah, thank you very much for having me on. I think you have to realize that this market is in the early stages of maturity, and you're going to see a lot of bumps along the way. As you mentioned, there was a lot of scrutiny around software exposure. We have said that the question is not good or bad software exposure. It's what is it? How well is it embedded? What is the structure of the loan being provided to the software company? So there's a lot of issues around that. We've also seen a lot of issues of late around liquidity, retail investors perhaps not understanding the features of the private credit market, and that's created some volatility.
Yeah, I wonder about the Boaz Weinstein said a couple days ago, one of the greatest accomplishments of private credit masters of the universe was convincing the market that this is the best thing since the internet, when it's really just lending money to small companies. What's the differentiation, though, that you actually see, Mark?
Yeah, private credit is offering something that the banks and the public markets have not offered to date. They're providing bespoke lending there to borrowers. They're providing certainty of execution, and they're providing speed. And to the investors, they're providing diversification, duration, and enhanced yield. And the alternative asset managers are managing that paradigm and have seen a lot of growth as a result of doing that.
Mark, I was speaking to a lawyer that does a lot of private credit work last night who basically said the Blue Owl stuff is a red herring. KKR, Ares share selling off, all of that is a distraction. The real issue is these more mid-sized, mid-market lenders that have, because of competition, had cov-lite deals or have just rushed and signed essentially really bad loans that they've done PIK, they've done it once, they've done it twice, and finally things are going home to roost, and they are saddled with these zombie companies. Are you seeing the same pressure in these, again, more mid-market type lenders, that there's some real issues among them?
I can tell you we haven't. This current episode is really all about liquidity. It's about providing liquidity to retail investors that are investing in long-dated assets. The assets themselves have performed quite well. And quite frankly, the recent sale of assets by Blue Owl at roughly par for a large portion of one of their funds shows that asset quality is actually pretty strong. This is really a liquidity story, not an asset quality story today.
Mark, do you think it was then, I know the market reaction to it was pretty bad, but do you think it actually makes sense then what Blue Owl did? Put the gates up for the redemptions, but instead return money on a more regular basis?
I mean, there is a soft promise that business development companies have, and that is around providing roughly 5% of their assets in towards redemptions every quarter. It needs to get approval by the board. Typically, we've seen them give that 5%. In periods of stress, we've seen them go over that 5%. So Blue Owl recently went over that 5%, but that's not new. We saw that during COVID, where a number of other business development companies provided redemptions up to 6, 7, and 8%. These elevated redemption periods typically last 1 to 2 quarters. We saw elevated redemptions in the fourth quarter of 2025. We expect to see elevated redemptions again in the first quarter of 2026. But what's important to note here is on a net flow basis, business development companies are still seeing positive inflows. The outflows is just one side of the story.
They are still trading at such an extreme discount to NAV, Mark. It's pretty remarkable. I mean, are any of the fears founded, do you think? We were just talking with the CEO of BXPE, that's Blackstone's private equity portfolio or product for wealthy, who was saying investor education is so important. Do you think that there is just an issue where maybe the Blue Owls of the world haven't, or other BDCs haven't fully educated their investors enough to say, hey, maybe you shouldn't expect as much liquidity from this? Like, where are the mistakes being made? Because clearly there is some fear out there.
Yeah, the market has definitely been spooked, and it's moved much farther beyond just the pure BDCs. And that has to do with the lack of transparency, the concerns around valuations, and the illiquidity of this market. But what I'd like to really emphasize is that illiquidity is a feature of this market. It's not a bug. There is a need for more investor education. That is for sure. Retail investors are used to liquidity. Institutional investors are not. And they're very careful and they're very thoughtful and typically buy and hold investors. Retail investors, again, are not that type of investor. So as the industry seeks to bring in retail money, they need to do it very carefully with education. And this is just highlighting the challenges that the private credit industry is having now and will have for some time as they bring in retail money and get retail investors up the learning curve.
Mark, I only got 30 seconds here, but just hearing from you, have they gone too far too fast then? Are they bringing in money faster than they are doing that work to educate?
That is a really good question. The market would tell you that maybe there's been investors who have rushed into this without full knowledge and full understanding of how this market works and the illiquidity that is present there. And so we'll have to see. But there may be a small pullback in the short term, but longer term, we think the trajectory of the private credit market will continue in the way we've seen it recently. Someone asked me the other day about, what inning are we in?
Yeah.
I would say the national anthem hasn't even been sung yet.